Okay, Stuart asks, what is the stock standards of how far out you recommend to sell covered calls? I sell for about 20% income and the rest I reinvest. In an instance, I noticed if the stock is down from where you bought, you have to push out to get adequate income. That's true in those cases. And in these cases, what do you recommend in general? How far to push out as we are weighing the odds the stock might recover as well? Then also losing potential premium if you would have held off waiting for premium to go up higher than if you bought. Okay, let me try to take this one at a time. Okay, there's no real rule of thumb. Okay, there's a rule of thumb for covered calls. Personally, Ernie and myself, if we're doing a covered call structure in our portfolio, we're likely under 30 days out in time. A 21, some maybe even 14 days, weekly covered calls are very popular as well. And the reason why I say that, Stuart, is because we get the better annualized return. Selling month by month, selling week by week, you get a higher annualized return. Another advantage of selling a weekly or selling 2 weeks out in time, in the situation you mentioned, if the stock starts to fall against me, then I've got many more choices to roll the position to. I could roll out to the 4th or 5th week out. I could roll 1 month out. I could roll 2 months out. Whereas if I sell for a higher premium that's not linear, meaning if I sell a 6-month out call, I might collect 10, 15, 20% of premium. Well, actually, it'd probably be further out, but yeah, 10, 20 to 15% of premium. But now you're right. If it starts to move more than that 20%, Stuart, and I'm getting hurt on that position, I don't have many choices to roll out to. I have to either stay in the same expiration if it's the last expiration available, or I might have to go out from, let's say, January 2023 all the way out to January 2024 to try to repair the trade. That's why we like to personally keep it shorter term. But we've talked about this before. One of our, the simulated CD search. This is another approach that's used, and it's, as you mentioned, going far out in time, to where what I'm looking to achieve here is, okay, where's that one I saw, Delta? I'll buy it at 43.03. I could sell the slightly in the money January 35 call for 14.05. Right away, I'm collecting 33% against the stock price. Now, that's my downside protection. The stock has to fall now 33% before I start losing money on the position. And, oh, these are 24s. I'm sorry. I thought they were 2023. These are 2024, 630 days out. But again, if it stays above 35 and I get assigned, I make roughly 22%, but that's for 630 days, so roughly 11% per year. Let's just go to the shorter term ones. Let's go to 270 here. Keep it to 270. Oh, let's go 150 to 270. Change that up a little bit, Stuart. And Delta in this list. Yep, there it is. Okay, so there's the 2023. So yes, now I'm collecting 26%, 27% almost. We're collecting $11.50 at midpoint against the $43 stock. So we're collecting 27%. And in 266 days, if the stock stays above 35, I still make 11%. Okay, that's great. My annualized, if assigned annual, is 15%. Okay, so that means if I could, not doing it every 200, but if I could do another one averaging out 100 days after this for the 365, it'd be about a 4% increased return. Let's stick with Delta. And what I'm going to do is put in all expirations on this, and I'm not going to use one result per security. And we're going to take out the percent if assigned annual. And we're just going to put, we're going to go 15 to 20% in the money. We're going to go at the money. I'm sorry. I just want to bring this up, Stuart, as to part of the reason why. And we're going to go 2 to 270 days out in time, just on DAL. Okay. Oh, I'm sorry. I'm sorry, folks. And there we go. I wanted to put right at the money. I'm sorry. Okay, and my highest return. Okay, so this is sorted by the highest percent return if assigned. We're going to change it to annualized. Fantastic. Okay. 7-day out, 43.50 strike is worth 91 cents, 95 cents at midpoint. It's only a 2.2% downside protection for 7 days and a potential 3.4% return. If we're assigned at 43.50, maybe I should have gone one strike in the money, but that's okay. And it's at the annualized returns at 175.2. Now I know you know this, Stuart. I'm just bringing this up in this case. You see, the further you go out in time, even though you're collecting that 20%, 13%, in this case, the 20% would have been the in the money one, Stuart, but we're still collecting 13%, 10% against the underlying stock price going to September with the at the money strike, 5% here. We're lowering our potential annualized return. And again, as I mentioned before, if I sold the September here and I collected a 10% downside protection, we collect $460. But what if Delta dropped down to $37 in this case? Yeah, I'm selling it at the money, not an in the money that you might be doing, Stuart. But it falls down to $37. We had $460 here. We had a protection down to 39. Our break even is around 39 or so. 38.70, 38.40, I'm sorry. But now it's down to 37 and it's dropping. Where can I roll to? To December, to January, and to January 2024, which I didn't have on here because I cut it short. I only have 3 choices. If I get into this position here, 14 days out, I'm collecting about $1.39. It's a 3% downside protection, but let's say again the stock falls in this case and it drops down to 38. I can see if there's rollout opportunities in the portfolio tracking this covered call out to May 20th, May 27th, June 3rd, June 10th, June 17th, September, December, and so forth. Now, yes, if I was in that September position, Stuart, whether it was in the money and you collected your 10%, 15% or 20% or so, and it was June or July when the stock started to fall to 39, 38, and 37. After we've crossed May expiration and maybe crossed June expiration, we're probably going to have an August available. We'll have a July available, especially. We'll have the July probably available right after the May expiration, if I'm not mistaken. And then we might see the August. There might even be a November that comes out. So you'll see, of course, more expiration opportunities on a single stock as you progress through the position. But in general, we like to keep it shorter term. But if your approach is to have the least amount of concern, the highest downside protection by collecting the highest time value, not the highest annualized time value, but the highest time value for the longer distance, that's why we do show that simulated CDs. It is an approach there that we use. And as we saw, if we went out to 2023, we're collecting 13%. Let's just go back to the standard one. I'm sorry, let me go back here. 180 to, yeah, that's right. 180 to 270, and we were going 15% in the money. So I've got to take that other level out there. Okay, so we'll go back to that standard list that we had. Sorry, folks. Fantastic. All right. Great. Okay, so there we go. That's a good one there. The 36, 24% immediate downside protection. But again, this is December, of course. But if it starts to run against me, if I'm buying this back, now this is another problem that I've found. We've had some recent coaching session conversations on this this week. I think we even talked about it last week on the webinar. I don't recall. However, one thing to keep in mind about these leap options or options that are closer to leap options, this thing is going to retain a lot of its time value. Let's go to the January one, we're originally looking at that 35 strike with a 27% downside protection, potential 11% return on the position for 266 days. Right? We just want to take a look at the profit and loss chart here, Stuart, in that scenario. Now, we're 8 points in the money and collected 1150. So roughly the max profit is about 350. That's the time value. Well, it's 10%. Well, okay, that's the return there we're looking at. Against the $43 stock there, but our cost base is really $31.53 after factoring in this price. But the max profit is $347 off of a true investment of $31.53, 11%, probably a high probability of getting assigned on the position. But let's say the stock falls pretty dramatically in the next 90 days or so. Let's say it falls down to $37 on that position. Okay. Yes, we collected $11 up front, but we only got $3.50 in time premium. And 3 months from today is going to put us, August 29th. Yep, there we go. The expected price of this option is still $5.61. And that's in 90 days, Stuart. So remember, we collected initially $347 of time premium. You collected $11. I get it. That's intrinsic in this case and the time value. But you collected $350. As the stock is falling and this option is going to at the money, even though time is passing, here at 37, we're $2 in the money. The expected time value is still $3.61. The time value buyback cost is still higher than what we originally collected because of the at the money bell curve, number one, but also this is still 260 days out. We still have 170 days to go. So we sold it here at 35 at the lower range. We collected a lot of intrinsic, but we're on the in the money slope side of the lower time value. And here is out of the money. But now that the option is moving down in price, is it called, did I take in the $11? Yes, that's not what I'm saying. We took in the $11, absolutely. But rolling and adjusting covered calls is the time value game. You're trying to maximize the time premium for the return. If you're selling out of the money covered calls, especially, you're playing the time value game. All right, you want time value decay in your favor. And in this example, we actually might expect time value to increase because we're going here now. Our 35 strike with the stock at 37 is now on this portion of the at the money bell curve where that extrinsic value swells. Even though we've passed 90 days, we're seeing potentially here 2 points in the money, a time value of 361 when we originally only collected 350. Okay. But yes, I took in 11 because I sold it in the money in this whole example in this case. Okay. And so that's what we like to do. But in general, if I let me reread your question, how far out you recommend to sell covered calls? Usually no more than 60 days out in time. Okay. We like personally to do, 14, 21 to 30 days at a time. Weekly covered calls are good as well, and they give you more opportunities to roll, Stuart. We like to keep it in the shorter time frame to maximize that annualized percentage return. That's what we were looking at when we ran that search. When you saw the weeklies had that 100, I'm off that screen, sorry. But the weeklies had that 175% annualized percent return if assigned. And it started to drop drastically as we went 90 days out, 80 days out, and so forth to those lower values. And even if I'm not trading the same stock, even if my plan isn't to roll it, if I'm trading, 1 week out or 2 week out or 3 week out covered calls on different stocks hoping to get assigned, if I'm still getting 1.5% premium for that 1 or 2 week out cycle, okay, 0.8 for 1 week out, 1.2, 1.3 for 2 weeks out, maybe 2% for 3 weeks out and so forth. But if I'm doing that every 2 to 3 weeks, I'm going to get a higher annualized return, even though I'm doing different stocks. And as you can see here, let's go right back to at the money for this other view here. I'm going to change my time frame again, Stuart, real quick so we can emphasize this. What did I do? 2, I think. 2 to 270. Okay, so these are close to all the same strikes. But what we're looking at here is that 15 days out in time, I know it's not a great example. Let's go here. 35 days out, the June 3rd position, it's $2 for the 44 strike. We go 140 days out in time. It's 4 times the amount out in time. Am I 4 times the premium? No, I'm just doubling. A little bit more than doubling, but I'm not 4 times the premium. This is 4 times the amount of time. So it's not 8 points. It's at 450. Okay, and out here we're at 9. A little bit less than 9. So about 8. Let's say 8. About 8 times the amount out in time, but this is not $16. It's only $5.88. Okay, so if I sell this every 35 days, $2 after 4 cycles of 34 days, selling the at the money option and collecting about $2, assuming volatility stays the same, That's going to put me at roughly $8 premium. Yeah, it doesn't work that way. We know I'm going to be rolling, I'm going to be adjusting, but that's going to give me 8. Even though this is giving me a 10% downside protection and still a good percent return if assigned for 140 days, it's about 1% per day here, I might be better off going shorter term to maximize the annualized profit in this case. But again, the approach you're using and what we call the simulated CD is a useful approach. I don't know if you're selling in the money, by the way, Stuart, or if you're selling at the money or out of the money for that 20%. But the reason that the simulated CD approach is good is because you have a great downside protection. You still have a good 200. Oh, these are the 600-day outlets again. I'm sorry. Good downside protection here. This is on a EXEL. Good return if assigned for 260 days. 14%, not bad at all. And I don't have to worry about it. I can put on this trade and walk away. I might not even have to set any alerts on it. I might set one alert if the stock reaches within, drops down to $20 or $19 per share. It's at $22.34. This might not be the best example. JD.com one here is maybe a little bit better. Selling the 50 strike, getting almost a 30% downside protection again with a 15% return. But I'm selling the 50 call. It's 231 days out. The only alert I might set on this position if I entered in my portfolio, of course, is then to go ahead and set an alert that if the stock reaches 52, you might need to consider some management. You're doing, I understand, something on top of this, but this also may be exacerbating the issues that you're having. Remember what Stuart said initially. He wants to get this high premium, this 29% downside protection against the cost basis, taking an $18.20 against a $61 stock because he's going to reinvest most of that. Well, now that does bring a double dilemma of how much should you leave behind to potentially roll or adjust this position as it starts to fall. Remember in our example, 90 days of looking at that covered call position that we had on DAL, I took in 1160. It was roughly that 12%. I'm sorry, that was about 15%, not 20 in that case. But if I take in that $1,150 for 100 shares, and I put 900 of it to reinvest in a different position or a different strategy, and in 90 days the stock falls down to 37, I got to find that $561. Hopefully I've made it in my trades over those 90-day periods, but that might lead to some of the problems you're running into because you use that premium that you got right away to reinvest rather than have the capital there for a roll or a management position. Of course, yes, I enter the roll entry. I've got to have the money to buy this back, but I'm going to get a new premium. I get that. But again, Stuart, if I'm understanding your question correctly, part of the problem with doing these farther out options is number one, the lag. Sometimes they don't respond right away. Number two is that if it's falling and you're getting closer to it, the ATM bell curve kicks in where, yes, I took in 1,150. I only have to pay back 560, but you took most of that 1,150 from what you said to reinvest the position. I'm not seeing the time value decay as rapidly because I still have 170 days to go on this one. And my only choices to roll to, as we saw, were either to keep it in January or now go all the way out to January 2024. That's why we typically like to keep it shorter term, but there is a great advantage on the position in that case, okay? Those are the things you want to look out for, Stuart, and that's why we prefer to keep it shorter term personally. But there is something to be said about that simulated CD approach where you have less worry, you have less time, but you have to also be concerned if you're using too much of that capital that you initially collected and not leaving enough to maybe buy back the positions depending on how close it gets that ATM bell curve and when that decline happens in those cases.